What the heck is happening in the stock market? What is going on with real estate? What is happening with all this madness in the markets?
The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right.
All right, welcome back everybody. Today we are discussing what the heck is happening in all the markets because it is craziness out there. We are seeing run-ups in real estate values. We're seeing one of the hottest markets in the prairie provinces that we have pretty much ever seen thanks to Toronto and Vancouver buyers. We are seeing the stock market basically come down into correction level off of the highs of November. And we are also at the same time seeing a mass amount of fear of things happening across the ocean. So there's a lot going on in the economy right now, and all of this comes down to essentially rate sensitivity, which we're going to discuss. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video and for the YouTube algorithm. And don't forget about our race to 25,000 subscribers, which we're getting very, very close to. When we hit 25,000 subscribers, we're going to give away $5,000 to one lucky winner just for subscribing to this channel. But in order to win, you have to be subscribed. Go ahead. It's free, it's easy, and it's definitely worth it. So let's get into it. Let's discuss what is happening in the stock market today. What's happening in markets in general. Basically, to start this off, what we're seeing is essentially rate sensitivity, and it is significant rate sensitivity to the point where the Federal Reserve in the US and the Bank of Canada haven't even made a move yet. Just the expectation that they are going to make a move sooner than expected is causing markets to basically crash. And the reason for this is really simple. What happens in general when you have an economy that has an excess amount of cash in it and an excess amount of available credit is it creates what's called speculation. And speculation is when people get into markets thinking that there's no way to lose money, that the values of things are only going to go up and up and up. And if they don't get in now, they're going to miss out, i.e. Toronto and Vancouver investors investing in Calgary real estate. But we'll get to that later on. And what ends up happening is you get all this credit that floods into the market. And as a result, as soon as the first hint of higher interest rates come, or the first hint of that liquidity being drawn out of the market happens, we start to see markets fall. And this is very much what happened leading up to the 1927 market crash back in the early 1900s. And it is very much what is happening today. We are seeing the liquidity being potentially pulled out of the market via higher interest rates. And as a result, we're seeing markets basically go crazy. So let me jump you into the screen here, show you real quick. This is real interesting. Between the time I started to set up filming this video and now, the Dow Jones Industrial Average has gone from being down 190 points to only 10 points. It was down as much as 300 points earlier in the trading day, and it has bounced back similar to what it did yesterday. Yesterday, it got down as much as 900 points and bounced back to it ending up in a positive day. And this is likely caused by people basically buying the dip or buying the down market. They see the market go down, and because of things like YouTube and better access to information, people are now realizing as speculators that if they buy the markets when they go down, they tend to do very, very well. But the problem with this is that it ignores the fact that there's still these massive market dips. And what's happening in these massive market dips is people are essentially getting scared of higher interest rates and less liquidity, and they're getting out of the market as they start to try to predict where the top of the market is. Now, I don't know if this is the top of the market. I don't know if this is the beginning of a bear market. We can definitely say it's a correction because the S&P and the NASDAQ have reached that 10% off of their highs benchmark, which is the benchmark for a correction. So we definitely know that the market's correcting. But whether or not this is the high of the market or the low of the market is really interesting. But what else is leading to all this is different things that are happening. Now, if you take a look across the screen here, you can see Dow Jones Industrial Average is down, S&P 500 is down, NASDAQ is down. NASDAQ is down quite substantially. By the way, tech stocks, which I'll get to in a second, are leading to a lot of the fear in the market at the moment. And then you see the VIX over here. This was green a second ago. It is now come back into red. But I want to take you in and show you the VIX, because what VIX is this is the volatility index. And the volatility index is one of the one of the indicators that Warren Buffett likes to point out. And when the market gets very, very volatile, it usually means that there's going to be some sort of a pullback. And what you can see on the volatility index is back in November, when the Federal Reserve first started talking about actually increasing interest rates, the volatility index got really high. We saw a pullback in the market back in November at that point in time. Then we saw things kind of get, back to normal. And now as we approach the Federal Reserve and the Bank of Canada having a interest rate announcement here on Wednesday or tomorrow, what we're seeing is this volatility index get very, very high again. And what that means is that people are fearful of the market basically crashing or going down because of higher interest rates. And if we start to take a look at what's causing all this, well, first and foremost, one is it's higher interest rates. But next, it is the fact that stocks like Netflix and Peloton are not performing well as we are exiting the pandemic. Now, there's a whole bunch of thought process around this, which I want to go into. First and foremost, Netflix and Peloton both did very, very well as it started to become clear that we were going to be locked down for extended periods of time in March of 2020. And as time has passed, the demand for these products has started to go down. In fact, Netflix surprised the market by saying that they were only expecting 2.5 million new subscribers this quarter. That was less than half of what the market expected, and therefore it had a pretty significant impact on the Netflix stock. In fact, it's like on the Netflix's stock ticker, the pandemic never happened. So in other words, Netflix value is now back to where it was pre-pandemic. Then we see Peloton having the same sort of issue here, where they have actually stopped production of their bikes because the user growth isn't expected to be as high as expected. And basically what this all means is that these stocks that were very much deemed to be pandemic stocks that were going to do very, very well over time, they're essentially now in a position where they are not as performing as they once were. Now, there is basically three things you can attribute this to. Most people are saying, well, we're nearing the end of the pandemic, so that stay-at-home period is kind of over, so that's probably why it's not performing well. The second way you can look at it is that all the demand for those bikes and those Netflix subscribers that was going to happen over the next 2, 3, 4 years got shifted from the future to 2020 and 2021. And the third way, and here's what I think is happening, is you can look at it from the perspective of people are just stopping spending on discretionary items like subscriptions to TV and movie services and bikes that they're going to place in their bedrooms and allow dirty clothes to build up on. Don't ask me how I know about that, but that's what happens with those Peloton bikes. So what I suspect is happening is a little bit more than just people are not on lockdown mode anymore, but people are actually starting to spend less. And there's lots of data that supports that people are stopping their spending, they're stopping borrowing money, and they're expecting that higher interest rates are going to come and the economy is going to slow down. So just this thought process of interest rates are going to go up is having an effect on the economy, which leads to the next point, which is what's going to happen with the interest rates and with the Federal Reserve Bank and so on and so forth. So here right now, what we've got is we've got CNBC out with this article saying the Fed is likely to signal a March interest rate hike and further policy tightening at the end of tomorrow's meeting. Of course, before the Fed announces tomorrow afternoon, we're going to see the Bank of Canada announce their stance on interest rates in the morning, as well as release their monetary policy report. I would suspect that given everything that's happening right now in the economy and the fact that inflation is something that is a real concern for Canadians and for Americans, that the Bank of Canada is probably going to move tomorrow to a higher interest rate by at least a quarter point. Now, they may not do this seeing what's happening in the economy and seeing what's happening in the stock markets and seeing what's happening with consumer sentiment, but I just have this feeling that it's something that is definitely on the table. Now, they may not want to spook the market, so they may not do it altogether. But really what we're seeing here is we're seeing a lot of volatility, and we're seeing people just get used to the fact that it's going to start to cost more to live in both Canada and the United States, which means they're going to tighten down their spending, which could have an adverse effect on the economy, which is lower growth and therefore almost in theory, at least a recession, which could lead to them not being able to increase interest rates by as much as expected. Now, one other thing that is happening in the US right now and across the world is the Pentagon is amassing 8,500 troops on heightened alert as the US weighs military action against Russia. Russia obviously has been amassing troops along the Ukraine border. It appears as though they're going to make some sort of move to try to take over the Ukraine. Who knows what's going to happen here? But basically with the tension of the fact that the US and Russia could go to war, along with the underperformance of darling stocks like Netflix and Peloton, combined with impending higher interest rates, is leading the economy to go into this spiral that is both down and then up and then down and then up. And it is just showing that there is so much speculation happening and that we're likely in for a rough ride over the next few months. Now, with respect to interest rate sensitivity, again, seeing that the interest rates could go up is causing major market fluctuations to the point where I don't think I've ever seen interest rate sensitivity be as high. So what I mean by that is just the thought of interest rates going up is having huge effects on the market. And I suspect when interest rates do start going up, that it's going to affect the market substantially more than what most people are predicting. So what that means, in theory at least, is that there could be less interest rate hikes as they start to happen and as we start to realize that small increases in interest rates are having a really huge effect on the economy. Because you have to remember, back in 2010, 2011, when they started increasing interest rates after the financial crisis, the economy was very much back on its feet and things were moving in a positive direction. As of right now, with respect to the economy, what we're seeing is we're seeing new variants all the time. We're seeing all this positive news, and then all of a sudden it's like November hits, Omicron hits, and all of a sudden we're back to where we began type thing. And what that means is that we're still seeing volatility and we're not on this upward swing. We're on this baby steps upward swing, hoping that we aren't going to have another sledgehammer hit us and drop us back down and so on and so forth. So, there's lots of really, really interesting things happening here in the economy. And I think with respect to interest rates, it's a really hard call to make. I don't envy the Bank of Canada or the Federal Reserve having to make these decisions with respect to the economy. Back before that 1927 crash, where they were playing with interest rates and where interest rates had come off emergency lows just after the First World War, it was a really, really interesting time and a really tough time for banks, for Federal Reserve banks and central banks to navigate what was happening. And I don't suspect that this is going to be any easier than that. And I fully suspect that at some point in the next couple of years, we're going to see a pretty big drawback in market prices for both stocks and also a pretty big drawback at some point, at least temporarily, for real estate. Now, as far as what you do with your 5-year fixed versus your variable mortgage rate, which is something that we always touch on, if you've got a variable rate right now and you are thinking about locking in, you're probably paying about 1.45% and your lock-in rate is probably about 2.75%, which means you have about 6 interest rate hikes before you would get to the interest rate where you would be locking in at. So locking in with certainty does not make any sense right now. What we look for is we look for those interest rates to come together when they get close. Then we maybe think about it. But right now, there's still significant savings to be had on those variable rate mortgages. Of course, if it's going to keep you up at night, we obviously recommend that you lock in so you're not worried about it and you're not having freak out panic attacks. But at the end of the day, right now, it's slow and steady on those variable rate mortgages until such time as interest rates do start going up and until such time as those gaps start to narrow. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers. We'll see you on the very next one. Cheers.